With the fall of UST, the fall of Anchor protocol, and everything related to Terra Luna ecosystem, people now are scared to invest their money in crypto because even the safest doesn't mean that it was really safe, but even the low yield compared to the crypto market, which offers you billions, millions, thousands percent in APY, that 20%, a lot of people saw that as a safe place to store their money, to have fast liquidity in case they needed to withdraw their money. So that 20% plus the liquid UST that you could deposit and withdraw whenever you wanted made people very interested in Anchor protocol. So a bunch of people now are scared. They are withdrawing their crypto from any place and either just holding them on their ledger, holding the blue chips like Ethereum and Bitcoin, or they are transferring back to fiat instead of having any crypto at all. They're zeroing their position, they're closing their positions on all crypto and going maybe back to the stock market, or maybe just holding cash on hand because people are scared. Does that mean that now we don't have any other options to generate that yield, a safe way to generate that yield? Well, we do. In my opinion, I still think yield farming, stablecoin yield farming is a profitable thing, especially if the network or the protocol we're investing in does not own the token itself. For example, if you're farming USDC or USDT on Beethoven X, on UDX, on Beefy, these protocols right here, and these networks, Phenom or Avalanche or Binance Smart Chain, they don't own USDT or USDC. So that way it's kind of hard, it's very hard for the protocol to melt and bring down the token itself, or vice versa, for the token to melt and bring down the protocol itself, just like happened with Terra. Anchor was created by the LFG organization to incentivize people to hold that UST and receive that 20%. So Anchor, UST, Luna, they were all part of the bigger picture, which was the Terra ecosystem. They were connected by the LFG organization. So if you're still farming stablecoins, I am also farming stablecoins. I took a loss, of course, on Anchor. Everyone did. Anchor was dear to a bunch of people, and whoever now is being hypocrite and saying that no, it was a Ponzi and whatever, but did have money over there, well, these people kind of suck because they now are talking trash about Luna, while overall they were profiting, they were making money until they weren't on the protocol. Now I'm going to show you something that I already spoke about in another video, which is crypto options. When I covered crypto options, when I covered Dopex a couple of months ago, I think it was last year, I think it was 2021 still, it was way different. Now we have a ton more of stuff. I even said it in the end of the video. I hope we get closer to what the stock market is offering with the Greeks, with a bunch of options where you could choose from, different strikes, and we're getting there. We're getting there. I'm going to show you everything that we have right now, which is feasible for you to use. Of course, there's also other things for you to use, other protocols that I'm not going to mention here, but overall, these do work in a really simple way. I'm going to show you how to generate yield from these options. I'm going to explain you what is an option if you don't know, so you can understand how to get this yield. And again, this yield is going to be different than, for example, that 20% from Anchor or something that you're yield farming. Because, for example, on Anchor, you were minting UST, so creating out of thin air, you were printing UST to give to holders. So whoever was staking, they were receiving brand new UST out of the printer. Same thing goes to yield farming. They were generating protocol tokens, governance tokens, and giving that to you. So they're creating something out of nothing. So eventually inflation will destroy these tokens that you're receiving, and it is not healthy overall. Now, for options, options are derivatives. So you are betting on tokens that already exists. You're betting on strike prices. I'm gonna go more into detail in a little bit, but right now, let's take a look at the protocols that we're gonna be looking into today. The first one we're gonna be looking at is called Katana. It is on the Solana network, so it is Friction. Friction is gonna be the second one. So we have Katana, Friction, then we have one of my favorites for the simplicity that it has, Of course, sometimes it can be very basic, but it is Theta nuts. Now, Theta nuts, it is cross-chain. You can jump between chains, and Theta nuts right now, I am in the basic version, and it also has a stronghold version. It is called. It's a little bit different than the simple version where you just pick and choose. And then we have Dopex. Dopex also cross-chain, also multi-chain. So these are going to be the ones that we're going to be looking at today. And I'm going to show you how can you profit from this and how much can you profit from this. So without further ado, let's go back to full cam so I can explain you what is an option and how does that work. We have two different types of options. We have call options and we have put options. An option pretty much is a contract. You should be familiar with contracts on DeFi. Everything works by smart contracts. So this is exactly what it is. It is a contract between a buyer and a seller. The buyer is committing to buy that option if it reaches or surpasses the strike prices that they have stipulated. And the seller is saying the same thing, but he is forced to sell that contract if the strike goes, if it hits the strike or surpasses the strike that they stipulated. So for calls, the buyer is betting that the asset they're betting on will go up. For puts, the buyer is betting that the asset that they are agreeing on will go down. But it is actually the opposite for the seller side. When a seller sells you a call, they don't want the asset to reach the strike that they agreed on. So that way he can keep the money and the buyer doesn't get to buy that asset from the seller. On the put side, the seller doesn't want the asset to drop all the way to the strike price that they stipulated, because otherwise he will have to sell his asset to the buyer. So with options, if you're familiar, if you keep up with news, especially with stock market, you saw, for example, during the short squeeze with GameStop, a bunch of people opened call options and they made a huge amount of money because options tend to be more volatile than the asset itself. But this is on the buying side. So if you're buying a call or if you're buying a put and the option goes in your favor, so the asset goes in your favor, if you're betting it's going to go low and it goes lower, if you're betting it's going to go up and it goes higher, this way you make a ton of money. But this volatility comes with a risk. The risk being that you can lose that money. You can lose everything that you invested in. So if you buy a call and it expired worthless, you will lose that money. But now, if you are on the seller side, you're not going to have so much upside in percentage. So you're not going to make that huge amount of money that sometimes buyers can make, but you will have a sort of stable dividend that you can live off, that you can generate yield from. So this is why in stock, so this is why people call also selling calls or selling puts, they call them synthetic dividends, because it's generated for you from an asset that doesn't pay you anything for you to generate dividends from it by selling calls or selling puts. Then we're going to be telling the difference between selling a call and selling a put and when should you choose one from the other. So it seems hard, but it isn't. And how does that work with crypto? Same thing. For us farmers, for us people who want to generate income, passive income in a safe way, we would much rather sell options than buy options. Of course, buying options, if it goes in your favor, it is more profitable. But selling options, the majority of the time, you have less losses than from buying options. So this is what we're going to be doing today. We're going to be showing you how to sell these options. You're going to sell a covered call and you're going to sell a put. So we're going to start with friction, because with friction, we can actually analyze the overall market itself. So if we go right here to generate income, for example, we have a covered call on Bitcoin and annually is paying you 17%. You might be thinking, well, this is still less than Luna. This is still less than what I was making on Anchor. And I'll tell you, well, is Bitcoin down 100%? No, Bitcoin isn't down, isn't melting like Luna did, like UST did. So I'd much rather get that 17% on Bitcoin than 1,000,000% on UST right now, because UST is pretty much dead. But let's say you don't want that Bitcoin, you want AVAX. AVAX is already 34%. Well, very nice. Or for example, Solana itself. If you are a Solana believer, there's right here a 30% on Solana. Or on Ethereum, you can see there's even Luna right now, but right now they stopped Luna completely. From all of these, you cannot trade Luna anymore. Only if you are already positioned before the meltdown of Luna, then you can withdraw that money. That's what it says, withdraw only. But overall, none of these options that I'm going to show you right here, none of these protocols, you can trade Luna any longer. So for example, let's go to the AVAX one so I can show you right here. What you basically do, you deposit your AVAX or you swap Solana for AVAX from Wormhole, and this is it. This is as simple as that. And we have a strike that if it reaches the strike, then you will lose the difference between the premium that the buyers are buying from and the value that it is currently at when it closes the cycle. So right now, the strike price is at $50 and the expiration is for May 19. So if by May 19, AVAX is under $50, which I'm sure it will be, then you will get that premium all for yourself. Whoever bought that paid a premium for them to buy that option, and that premium will be yours. Now, how can we see if it is actually being profitable or no? With Friction, there's something really cool that you can do. You can click right there in analytics, and for example, you click on AVAX. And if you scroll down, you can see right here that these lines, these dotted lines right here are the strike price. And the blue line is the AVAX actual price. For calls, when you're selling calls, you want that line, you want a dotted line to be above the actual price of the asset. You can see each epoch is 1 week long. So 2 months, in these 2 months, there hasn't been a day where you didn't profit from these calls because you're selling calls, and even right here where it looks like AVAX went above, it didn't actually go through. You actually made money. You made 1.19%. Then right here, 0.34%, then 0.34%, so on and so forth. And if we scroll down even more, we can see right here. Look, from March 31st, you made 1% on that week. Then you made 0.31% on the April 7th week. April 14th, you made 0.31 again, then 0.54, 0.41, 0.33, 0.56, and right now we are currently also looking like we're going to be making something like 0.56. So you can see how profitable this is, especially if you're compounding it. So every week, so instead of unstaking, you just leave it there, it will compound for you. So this right here says in progress because we still have 2 days to go, which will expire the 19th of May. But you can see how profitable it is. For example, even for Bitcoin, you click right here, 17%. Look at how many weeks. Profitable, profitable, profitable. Just 1 week that you weren't profitable, maybe 2 weeks that you weren't profitable, and then all the rest of these weeks right here, you were profitable. But if we look at these 2 weeks right here, you didn't lose that much because you're not gonna lose all your money. This is the best thing about crypto options. You're just gonna lose the difference. So if we scroll down to when we lost, there we go, February 11th, we actually lost 0.50%, so not even 1%. We lost 0.50% of our investment. So you can see how profitable this strategy is. And you're using your favorite coins. You're using your favorite coins. You can see that even with Luna, look right here, with Luna, we have historical right here. With Luna, you actually just lost once, which was on March 3rd. So if we scroll down all the way to March 3rd, oh, actually you lost twice. You lost 2% on one and 3.4% on the other. So you can see how that it is really profitable. Of course, 17.9%, 17% might not look like a lot, but these are on blue chip tokens. These are on blue chip coins, on Bitcoin and Ethereum. Who wouldn't want that? Who would want to, instead of getting that 8%, 4% that you get on Bitcoin and Ethereum, why not get the 17% instead? Well, if for example, we look at Katana, we can see is even higher here. For example, for Bitcoin, it is at 21%. So we're way more than Anchor was paying us with Bitcoin, with actual Bitcoin. Here, we don't have that little graph that we have on Friction. We just had 1 week, 1 epoch of loss, but then everything else was positive. You can see right here, positive, positive, positive. And on the cumulative, we are from the beginning of the year, we have 4.18% yield on our Bitcoin. And if we go to analytics on Katana, you can see the actual yield for the covered call on Bitcoin and for the put selling on Bitcoin. You can see how profitable it is. Like for example, this week, the APY, if we compounded that for the whole year, it will be 51%. So you can see how profitable it is when you know where to put your money. Let's say, now the market has dropped. I don't think it will drop for the next week. So in the next week, if you still think it won't drop, that much, or if it won't drop to the strike that they're asking right here, then you can invest into this maybe. Then you can invest into this right here. It is up to you. But again, when the market is down, I always recommend you to sell covered calls. And when the market is up, I'd tell you to sell puts instead. Because selling puts, you want the market to go up. Selling calls, you want to protect when the market goes down. So selling calls is always a good thing to do. And on Theta Nuts, same thing. We have the put selling right here, or we have the covered calls. So we have blue and orange, blue being calls and orange being the puts. But you have to be careful because these right here already have strike prices preset. So you cannot choose the strike price. For example, right here on this put selling right here, the current price of Phantom is 37 and the strike price is 27. So if it goes under 27, I'm gonna lose money. I'm gonna lose that difference between the premium and the strike that it will be when it ends. And these are not weekly like the other twos that we saw on Solana. These are actually bi-weekly. So if you think by 2 weeks from now, or from 9 days, because it already has passed a couple of days, if you think Phantom will be over 27, then invest your money right here and you'll gain that premium. But now, for example, if we scroll to AVAX, I think it was AVAX, look right here. I wouldn't put my money in here. We have 2 days for we have 2 days for it to expire, and we're already under the strike price. So people who were in or didn't get out, they're gonna lose some money. They're gonna lose some percentages right here because the current AVAX price is under the strike price. So this difference right here will be their loss. But when this option started, AVAX was actually at 52, I think. Let's take a look. AVAX. So the fifth, it was the right here, fifth. It was $60. So who had AVAX at $60? They were like, wait, well, in 2 weeks it's not gonna go under, just because right here we had a support at 59. So people were convinced that we're not going to go under the support. So that's why people invested right here, because of course, for them to break the 50 and then go all the way $12 under to 48, it would take a lot. But it actually did. We saw a big meltdown on AVAX right here. And these people actually lost some money. But as I said, when the whole market is trading sideways or is trading down, it is always better to sell covered calls instead of covered puts. Now, for Dopex, it is a little bit complete, but it's also a little bit harder to deal with because right here, you're not selling, you're not a seller, you're a buyer. So you cannot sell them. You cannot sell them. Of course, you can do that over the counter, but I wasn't able to do that over the counter. So for example, if we go to this Ethereum weekly, this is a call. You're buying a call on Ethereum. So these are the strikes that we have. So if we have this call right here at a strike of $2,000, so we are already over the strike. You'll pay a little bit because you're already in the money with this, and the expiration date is in 2 days from now. But for example, if we think it's gonna go over, or if we think it's gonna go higher than it is right now, close to 2200, then we buy this. It's going to be a little bit cheaper than it is right now. And you can see right here the total premiums that you will collect. We already have 99% of the available options to buy right here, and this is the total premium that will be split once this epoch is over, when we can withdraw. So right here, you're actually buying an option. This is the riskiest side, the riskier side. But if you know how to do that, if you already have used options on stocks, then right here, it is something really good for you to use here. It is Dopex. Now, what if you don't know anything? You just want to let it go. You just want to get that yield. Well, then we have this, the stronghold version of Theta Nuts, which right now only offers USDC. But eventually it will offer Frax, Bitcoin, and Ethereum. And I love the way that they did it. So it is very simple. You will get a percentage, an APY of around 61. So imagine 61% on USDC. And they do that for you. So you can see it is 45 APR. It is 61 APY if you compound. So each month you compound. And how do they get that? How do they get this yield from? If you click right here and you go on Stronghold, it will show you what it is doing. It is selling all these options right here. So it's going to sell a 25,000 Bitcoin put. It's going to sell an Ethereum put, an AVAX put, a Phantom put, and all these other things for that combined yield that I told you about. And you can see they split it even. So everyone has 14.29%. And here we have all the transactions going on. And you simply deposit your USDC and you generate this index USDC that you can then swap it back to USDC. And if these calls actually generated money, the index price, the index USDC will be higher than the price that it is right now. So giving you that profit. When you swap it back to USDC, you will be profitable on that way. So this one is the better version of all of these. If you are kind of confused, you just basically go right here on the Theta Nuts, on the Stronghold Theta Nuts. You need to have USDC, just deposit that, and then it does everything else on the back end. Now, if you want to choose which token you want to invest to, I'd say either go with Friction. Friction is the only unfortunate thing is it's on Solana, but Friction has a lot of ways for you to understand, to see visually the strike that it needs to stay under or over if you're selling puts. Or Theta Nuts if you just want to have a bunch to choose from, because on Theta Nuts, of course, depending on the network you are, you have a ton of opportunities to choose from. Just make sure if you're selling a put, you don't want that token, that asset to go under that strike, and if you're selling a call, you don't want that token to go above that strike. So right now I am going deep into options, crypto options. I used to do synthetic dividends on stocks, especially on American stocks, because the yield is a little bit juicier. The expiration dates are weekly. In Brazil, we also have options, but the expirations are monthly. So you can compound at a higher rate with weeklies than you can do with monthlies. So I was doing that in the American stock market. And right now I'm going to start doing that heavily on crypto as well, because this, I think, if you were leaving your money on Anchor, if you were just leaving your money there for that 20%, this right here will be the solution for that. This right now is going to be how I'm going to leave my stable coins, my capital, instead of leaving somewhere where it's printing money. I'm going to just leave it right here with actual revenue from options. So we will see how it goes. Eventually, if something else gets deployed, I'm going to show you right here, show you eventually if Greeks get deployed. We can see how Greeks, we can choose strikes, a better variety of strikes, stuff like that. Then I'll also make more in detail video. But as I said, I think this right now is the best way for you to have a safe yield from crypto, other than yield farming on stablecoins. So I'm going to be splitting my stablecoins, whatever I have left from stablecoins, because I lost a little bit with UST, but whatever I have in USDT, USDC, DAI, and MIM, I'm going to be also farming. I'm going to be also doing this right here, especially with the stronghold on the Theta Nuts. But anyways, I hope you guys enjoyed this video. If you did, if you have any questions about how options work, how these protocols work, we're learning together. I'm not a master of crypto options, just because they are a bit different than normal options, but we're here to learn together, to grow as a community, to make money together. So if you have any questions, and if I can help you with these questions, just leave it down in the comments and we can see what we can figure out together. Again, thank you so much for your time. I'll catch you guys tomorrow for another video. Peace.